Welcome to vTalkInsight, Market Drivers Daily for April 15th, 2026. Middle East tensions, an uneasy oil market, and an AI-fueled equity rally are pulling cross-asset pricing in very different directions. Today we focus on whether this apparent calm really matches the underlying geopolitical and energy risks. Geopolitical risk is still the dominant macro driver, even though headline equity indices are trading close to record highs. Crude oil sits at the center of this story, acting as the key hub for cross-asset correlations, linking volatility indices, S&P credit spreads, and broader risk appetite. Recent headlines around the Middle East, especially threats to critical shipping lanes, produced only a contained volatility spike. The VIX briefly touched 31 intraday, well below last year's tariff shock, which hit 55 and drove deeper drawdowns. That combination of elevated geopolitical uncertainty but limited index damage sets the stage for today's valuation of tail risk. In the background, the security picture remains fragile. Shipping activity through the Strait of Hormuz has collapsed from pre-war norms of well over 100 vessels a day to just a handful attempting the passage, as the U.S.-led blockade forces merchant ships to turn back within hours. The Pentagon is deploying thousands of additional troops and warships, hardening bases, and enforcing the embargo, while Iran leans on asymmetric tools such as drones and proxy groups to retain leverage without outright escalation. Conflict has already cost U.S. taxpayers an estimated $42 billion in 2 months, and policymakers assign roughly even odds to a near-term resolution, expecting oil prices to grind higher before any durable deal emerges. Despite that backdrop, markets have steadily priced in a de-escalation narrative compared with earlier this week. Reports of progress toward extending the U.S.-Iran ceasefire, direct talks between Israel and Lebanon, and a more muted public stance from Tehran all support the idea that outright war risk is receding, even if details remain contentious. Equities are near all-time highs. Bank executives describe the U.S. economy as resilient, and flows into U.S. stocks, especially semiconductors, point to robust risk appetite. At the same time, asset managers have quietly reduced overall risk exposure and moved to a more neutral stance on both equities and bonds, reflecting a belief that the current calm may not last. One striking feature is how cheaply some market segments are pricing protection. 1-month S&P 5% out-of-the-money puts are estimated to be about a quarter cheaper than they were before the latest round of geopolitical tensions, even though uncertainty around ceasefire talks and shipping lanes remains high. Luxury and travel names tell a different story. European houses such as Hermes, LVMH, and Kering have seen sharp share price drops, with Middle East travel disruptions and weaker tourism in hubs like the UK and Italy weighing on earnings and raising the risk of a longer downturn in that niche. Meanwhile, wealthy clients are not only diversifying assets, but also booking centers and currencies, highlighting how geopolitical and jurisdictional risk are increasingly seen as linked. A key risk is that the economic fallout from energy and shipping disruptions proves larger than current pricing implies. European officials warn that ongoing Middle East conflict is already pushing growth and inflation away from central bank baselines, with stagflation risks rising as energy, fertilizer, and microchip components face bottlenecks. UK inflation expectations have jumped more than they did at the onset of the Ukraine war, underscoring how sensitive households now are to energy-driven price shocks. Yet markets continue to trade as if war risks have largely faded, shifting attention back toward structural themes like AI. The next 24 to 48 hours around ceasefire negotiations and any renewed strikes will be crucial for volatility, especially given how inexpensive index hedges look relative to headline risk. That rotation of focus from geopolitics back to technology leads directly into the second major driver today, the AI trend. AI remains the core, structural growth story underpinning risk appetite, and it increasingly explains why equities can sit near highs despite repeated geopolitical shocks. Capital spending on AI infrastructure is projected in the hundreds of billions of dollars over the next few years, supporting a powerful earnings tailwind for U.S. and emerging market companies. The rally is, however, narrow. Gains are heavily concentrated in a small group of large AI beneficiaries, while the broader market shows weaker breadth. On the hardware side, the momentum is clear. ASML has lifted its full-year net sales guidance into a 36 to 40 billion euro range, citing persistent and accelerating demand for advanced chip-making equipment essential for leading AI processors. Despite that upgrade, the muted share price reaction after a roughly 40% year-to-date rally hints that high expectations are already embedded. Broadcom has expanded its multi-billion-dollar partnership with Meta to develop custom AI chips, now counting 6 major hyperscalers as clients, with revenue from these deals expected to ramp toward the latter part of the decade. At the same time, NVIDIA's new AI models aimed at quantum computing have triggered sharp pre-market moves in niche quantum names, highlighting how strong the speculative element remains. The AI theme is also reshaping the broader ecosystem. Investor enthusiasm is evident in private markets, where Anthropic is reportedly entertaining offers that more than double its valuation within months, and in expectations for a wave of AI-related initial public offerings to help finance massive capex plans. Public flows show investors diversifying across the AI supply chain, from semiconductors to data centers and specialist materials, reflecting uncertainty over future winners and a desire for broader participation. AI firms are driving a notable revival in office leasing in San Francisco and New York, while cybersecurity demand is increasingly seen as non-discretionary as companies confront AI-driven cyber threats and geopolitical risk. Beneath the surface, performance dispersion and concentration risk are growing. ASML has outpaced a broader European AI equity basket that is up around 40% over 12 months, underscoring how leadership is clustered in a few names. Semiconductor stocks and AI infrastructure plays with clear near-term cash flows continue to fuel Nasdaq strength, while software and SaaS names lag as investors question how their business models adapt to AI and how quickly they can monetize new tools. Some software stocks are now viewed more as value opportunities, but that thesis depends heavily on successful reinvention. At the speculative end, a former footwear company pivoting to AI infrastructure saw its share price surge several 100%, illustrating meme-like dynamics and raising asset bubble concerns. There are also growing frictions where AI meets energy and regulation. AI-driven data center expansion is running into hard power constraints, with grid connections and transmission build-outs taking years, while electricity costs in parts of Asia have become a political flashpoint as hyperscaler demand collides with energy market disruptions. Companies such as Oracle are turning to alternative sources like fuel cell power to secure reliable supply, and local resistance to new data centers in some U.S. regions is intensifying as residents face higher bills and environmental concerns. China's more streamlined permitting and state support could allow it to scale semiconductor and power infrastructure faster, potentially giving it an edge in the AI race versus Western peers. Questions also linger around return on investment. Meta, for example, is pouring capital into AI chips and infrastructure without a traditional cloud business, banking instead on better ad targeting and new hardware experiences. All of this means AI continues to support a constructive earnings outlook, but with meaningful valuation, regulatory, and infrastructure risks that could amplify any future pullback. Those same energy and power constraints are a natural bridge into the final theme, the evolving energy shock. The energy complex is where geopolitical risk and the AI cycle most clearly intersect with the real economy. Oil remains the key transmission channel. It drives inflation dynamics, shapes regional growth prospects, and is currently the main anchor for cross-asset correlations. Despite some recent stabilization in headline prices, The underlying picture still looks like an evolving energy crisis rather than a resolved shock. The most striking disconnect is between physical and financial oil markets. Physical benchmarks, such as Dated Brent, have traded up to $30 above ICE Brent, signaling acute shortage of immediate barrels even as futures curves imply a relatively contained disruption. Supply outages linked to the Strait of Hormuz exceed 10 million barrels per day, with inventories being drawn down quickly. If disruptions persist for around 10 weeks, stockpiles could fall to their lowest levels in more than 25 years and push prices above $200 per barrel. Strategic reserves, particularly in the U.S., have limited room for further drawdowns without hitting operational constraints, reducing the cushion against future shocks. Refiners and petrochemical producers in Asia are cutting operating rates due to tight crude and feedstock availability, while fertilizer shortages raise the risk of food stress in vulnerable economies. Macro risks from this energy shock are increasingly skewed toward growth. Analysts see roughly a 40% probability of a global recession, driven mainly by energy supply disruptions and prolonged shipping closures. The International Energy Agency estimates that to rebalance the market, second quarter oil demand would need to fall as sharply as during the 2020 pandemic, an adjustment that would almost certainly entail broader economic pain. Europe looks particularly exposed. Fiscal space to shield households is smaller than in 2022, and policymakers warn that restricted flows of energy, fertilizers, and microchips could generate a mix of weaker growth and higher prices. The European Central Bank is signaling flexibility, with inflation projections ranging from a baseline around 2.6% to scenarios above 4%, depending on how the conflict evolves. In the UK, officials face a trade-off between containing renewed energy-driven inflation and supporting sluggish activity, with the risk of multiple inflation waves even if tensions ease. Asia is also under pressure as rising fuel and electricity costs strain countries like India and Pakistan, triggering price controls, labor disruptions, and higher stagflation risk. Market pricing, however, reflects considerable optimism about a relatively quick resolution. Oil prices have retreated into the low 90s, and forward curves trade well below spot, indicating expectations for a phased reopening of Hormuz rather than a drawn-out crisis. Recent reports of progress on U.S.-Iran truce extensions and a fragile ceasefire help explain this, as does the perception that the U.S. economy, now a net energy exporter, is more insulated from oil shocks. Bank commentary and credit card data suggest U.S. consumers are still spending, with fuel representing only about 3% of total expenditures, and long-term U.S. inflation expectations remain anchored despite gas price spikes. Nevertheless, sustained high oil could erode the temporary boost from tax refunds and cap further equity upside, leaving indices trading in a range until the path of energy costs becomes clearer. Looking beyond the immediate shock, the conflict is accelerating a structural shift in energy strategy. Countries are likely to prioritize resource nationalism and larger stockpiles, while Europe and parts of Asia push harder for energy independence and even explore reducing reliance on the U.S. dollar in energy trade. The war is also speeding up supply chain rewiring, as firms diversify routes away from choke points like the Strait of Hormuz, though that comes with higher costs. At the same time, AI-driven demand for electricity is tightening power balances, with deals such as Oracle's move into fuel cell power underscoring how technology firms are competing for scarce energy resources. Key watch points now include the outcome of U.S.-Iran peace talks and ceasefire deadlines, trends in global inventory levels, evidence of demand destruction in energy-intensive sectors, and any policy moves on energy security or de-dollarization. Together with the geopolitical and AI dynamics we discussed earlier, these will shape whether today's apparent calm gives way to renewed volatility or a more durable adjustment. To wrap up, geopolitical tensions remain the primary macro risk, but markets are increasingly pricing a de-escalation, with equities near highs and index volatility contained even as physical oil markets stay stressed. At the same time, An AI-driven capex boom is powering semiconductor earnings and concentrating equity leadership, while energy shocks and power constraints create important macro and sector-level risks, especially for Europe and parts of Asia. Monitoring ceasefire progress, oil inventories, AI infrastructure spending, and central bank reactions will be critical for understanding how today's risk premia evolve across assets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.